Welcome back, everyone. In the last chapter, we learned how to record and post transactions. Today, we'll see how accountants make sure those records truly reflect the business's performance at the end of a period. That's where adjusting entries come in. Our learning goals: 1. Understand why GAAP EP requires adjusting entries. 2. Learn how to record different types of adjustments. 3. Prepare and use an adjusted trial balance. 4. Create financial statements from it. 5. Review the full accounting cycle. 6. Make closing entries and a post-closing trial balance. Let's get started. Before we talk about adjustments, let's recall the operating cycle, the time it takes a business to buy goods, sell them, and collect cash. Example: a clothing store buys shirts in January, sells them in February, and receives cash in March. That 3-month process is one operating cycle.
Sir, what if the company provides services instead of goods?
Good point. For service businesses, the cycle runs from providing a service to receiving payment. Same idea, just without inventory. GAAP requires that revenues and expenses are recorded in the right period. This is called the matching and recognition principles. To follow those, we record adjusting entries at the end of each accounting period. There are 5 common types. Let's go through each. First, prepaid expense, when cash is paid before the expense is used. Example: paying $200 for 1 year of insurance. Each month, we recognize 1/12 as an expense. Debit insurance expense $100, credit prepaid insurance $100. Second, depreciation is spreading the cost of an asset over its useful life. Example: equipment costs $12,000 and lasts 4 years. Depreciation $12,000, 48 months, $250 per month. Debit depreciation expense $250. Credit accumulated depreciation $250. Third, unearned revenue, which is cash received before providing goods or services. Example: a gym receives $600 for a 6-month membership. At month end, debit unearned revenue $100, credit revenue $100. Fourth, accrued revenue is revenue earned but not yet received in cash. Example: a tutor earns $200 but hasn't billed the student. Debit accounts receivable $200, credit service revenue $200. Fifth, accrued expenses are expenses incurred but not yet paid. Example: wages $500 owed to employees. Debit wages expense $500, credit wages payable $500.
So all these ensure income and expenses show up in the right period?
Exactly. That's how we make financial statements accurate and timely. After making adjustments, we prepare the adjusted trial balance. It lists all accounts after adjustments to confirm total debits, shows total credits.
And if they don't balance?
Then we go back and check the journal entries. Something's off. Once we have a correct adjusted trial balance, we can prepare the financial statements directly from it. Steps: 1. Income statement. Uses revenue and expense accounts. 2. Owner's equity statement. Shows changes in capital. 3. Balance sheet. Shows assets, liabilities, and equity. Example: if total revenues are $10,000 and total expenses are $7,000, the net income are $3,000, which increases owner's equity. By now, we've gone through nearly every step of the accounting cycle. 1. Analyze transactions. 2. Record in the journal. 3. Post to the ledger. 4. Prepare trial balance. 5. Adjust entries. 6. Prepare adjusted trial balance. 7. Create financial statements. 8. Close accounts. 9. Prepare post-closing trial balance. At the end of the year, temporary accounts, like revenues and expenses, must be reset to 0 for the new period. We do this with closing entries. Example 1. Close revenue to income. Summary. Debit revenue $10,000. Credit income summary $10,000. 2. Close expenses to income summary. Debit income summary $7,000. Credit expenses $7,000. 3. Transfer net income to owner's capital. Debit income summary $3,000. Credit owner's capital $3,000. After that, we prepare a post-closing trial balance, which contains only permanent accounts, assets, liabilities, and equity. Let's recap Chapter 3. Adjusting entries align financial results with GAAP timing and matching principles. We adjust for prepaid, accrued, unearned, and depreciated items. The adjusted trial balance ensures accuracy before statements. Closing entries reset temporary accounts for the next period. Now, let's practice. 1. Paid $1,200 for a 12-month insurance policy. Record 1 month's adjustment. 2. Received $1,000 for services to be performed later. Record the first month's revenue recognition. 3. Equipment cost $24,000. Life, Shakan 4 years. Record monthly depreciation. Solutions. 1. Debit insurance expense, $100. Credit prepaid insurance, $100. 2. Debit unearned revenue, $167. Credit revenue, $167. 3. Debit depreciation, expense, $500. Credit accumulated depreciation, $500.
So once we do these, are we ready for financial statements?
Exactly. You've just completed the full accounting cycle. Well done, everyone. You now understand how adjusting and closing entries keep financial data accurate and complete. In our next chapter, we'll explore merchandising operations and how inventory affects accounting records.